Happy Saturday, dividend growth stock investors. It is Colby, the DGI Crab, and as I typically do on a Saturday, if there is news of a dividend increase in the DGI Crab portfolio, I bring it to you here on the weekend. The DGI Crab channel covers 60 high-quality dividend growth stocks, split into 4 separate categories based on your age and your time horizon. Hormel Foods is in my Tier 3 category, which just means that I believe it is a stock most suited for a 42 to 53-year-old investor, and that's based on current yield and dividend growth rate. I believe age and time horizon are the most important metrics for a dividend growth stock investor to take into consideration when investing. I'm not offering financial advice as I'm not a licensed professional financial advisor. You should do your own due diligence before investing in Hormel or any stock or security for that matter. But that being said, I'm here to share my opinion and strategy with you. So this is the 59th year of consecutive dividend increases for Hormel Foods. This has been a stock that's been in my personal buy zone for a long time right now. Hormel has had a rough 2024. There's no doubt about it. But similar to when I was happy about the Nike dividend increase a few weeks back, seeing a dividend increase out of Hormel also offers me some reassurance that this company is still focused on the right things. So we're going to take a quick peek here at this Yahoo Finance Zacks article. Just pointing out they're increasing the dividend. It's about a 3% increase. So not a huge increase, but it is an increase for a downtrodden stock nonetheless. I will take it. 59 years in a row. They were previously paying $1.13 per share per year, and they've upped that to $1.16. So for every share of Hormel Foods that you own, you're getting an extra 3 cents a year in forward annual dividend income from those shares. So let's see. The 386th consecutive quarterly dividend payment. So they haven't missed a dividend payment in a very long time to go along with that streak. Their payout ratios, same as what I've got on my spreadsheet, still sitting around here at 71%, which is a little bit on the high side. When it starts to get north of 70% for most of these stocks, I start to get a little bit nervous, a little concerned, just something to keep an eye on. They do have a free cash flow yield of 5.2%, so that's not bad, and an annual free cash flow return on investment of 7.4%. And in the opinion of the Zacks writer here, they think that the increased dividend is likely to be sustainable, and I personally agree. I also wanted to show here something else in this article that I found kind of interesting, especially considering the season that we're in right now, is it says Hormel Foods continues to face significant headwinds from the turkey commodity market. Happy Thanksgiving weekend, y'all. Turkey, right? This has negatively impacted overall performance. The production disruption at Hormel Foods' Planters facility in Suffolk, Virginia has also been a notable setback, directly impacting the company's ability to meet demand for its snack nuts portfolio. This disruption has been impactful throughout the third quarter and is expected to linger into the fourth quarter, bringing uncertainty regarding Hormel's ability to fully recover from the operational bottlenecks by the end of the fiscal year. Shares of Hormel have lost 2.8% in the past 3 months against the industry's growth of 1%. So you see here, the red line here is food meat products. About 1% growth over the last 3 months. Hormel down 2.8% in that point in time. So why does that mean that I would be adding Hormel? Well, I like to personally add stocks when they are yielding at least 30% higher than their 4-year average dividend yield, which Hormel has been doing for quite some time now. I buy stuff when it's down personally, because my opinion on it is that I've got a higher opportunity to get share price appreciation by buying when something's already low, and I'm reducing my overall risk of share price crashes in an overall stock market downturn, because if I've got a stock that's already downtrodden a bit, it may not have as far to fall as some of the ones that are really flying high and appear overpriced at this point in time. So Hormel, I'll have to update my number here. They are up to 59 years of consecutive dividend increases. Payout ratio 71%. And yeah, 4-year average yield of 2.59%. And with that dividend increase, they are now yielding 3.58%. I personally like this deal. Hormel, not the most exciting stock on the list. And in fact, in 2023, their dividend increase was only about 5.7%. So their dividend increases have been a little bit on the slower side in recent years. But if we jump over here to Seeking Alpha to review the dividend yield, the growth, and the history, it's going to show an interesting story here. So first I want to look at the yield tab and look at the yield history dating back to 2014, where we can see what the average dividend yield was of the stock in each of these particular years. And you can see here from 2014 all the way through 2020, the average yield that Hormel had never hit 2%. So there were times during each of those years where the yield climbed above 2%, which would have likely been points in time where I would have been interested in buying it. But the average yield certainly was very low throughout those years. In 2021 and 2022, the average yield started to climb a little bit, but not significantly. And then 2023 and 2024, you can see that average yield just spikes way up, jumping from 2.1% in 2022 to 2.81 in 2023 to so far in 2024 basically being 3.5%. So we're seeing max yields here much, much higher than we've seen over the course of the last decade for Hormel. Now, let's scroll back up here and take a look at their dividend growth. Dividend growth on Hormel, as I showed you before, the growth on Hormel last year was 5.7%, and in 22, 6%, 21, 5%. But then if we go back past that, Hormel had a long streak of double-digit dividend growth. It looked a little bit more like a tier 2 level stock than a tier 3 based on the yield and the growth rate. I sort of preemptively perhaps put it in tier 3 when I launched the channel because I saw the last few years the growth rate was more in that tier 3 range of mid to high single digit annual year-over-year dividend growth, which is excellent for 42 to 53-year-old investors. Now, will Hormel get back to double-digit dividend increases? Well, maybe they will. If you look back, though, 2010s, super hot for dividend growth on Hormel. In the 2000s, looks a little bit more like it currently does, where we're seeing mid-single digits, 7%, some 5s, a 6. Going back into the 90s, there were some slow years in the late 90s of just 3% growth. But then in the mid and early 90s, it was double digits. So Hormel kind of goes through interesting streaks where sometimes they are just racking up massive dividend increases year over year, and then they'll have a few years where they slow it down, they get a little conservative, maybe they're going through tough financial times, there's challenges in the markets at any given point, whatever the case may be. But what the company has managed to do is grow that dividend for a lot longer than I've even been alive, and probably a lot longer than a good portion of you all watching out there have been alive. So that's how a company does it. They grow aggressively when they can, and they pull back the reins and act responsibly when times are a little bit tough. I believe that if I'm adding to my position in Hormel this year, maybe I won't get a high dividend growth rate in 25, maybe not even in 26, but eventually I do think there's going to be a point in time where the double-digit dividend increases start coming back, and that's going to average out my dividend growth rate over the long haul. So if we look back at the dividend scorecard, we can see even with the slower dividend increases over the last couple of years, the 5-year growth rate on Hormel is a pretty stable 6%. And the 10-year growth rate obviously would be a lot higher than that because we'd be going further back in time and factoring in all those double-digit increases from further than 5 years back. But a 3.5% dividend yield with a slightly better than 6% 5-year growth rate, that puts us very close to 10% if you add those two numbers together. And that's certainly one of the things that I'll look for, particularly in tiers 2 and 3, but really across all tiers. I'd like to see these two numbers combined to be 10% or better in most cases. And Hormel certainly checks that box. May not be the most exciting thing in the world to purchase, but if you've been concerned buying Hormel at any point in time this year, does this explanation, does this review of the history do anything to ease those concerns? Do you think there's going to be more tough times ahead for Hormel before they recover? I couldn't say when the recovery happens. I just know when something looks cheap, I want to buy it when it looks cheap. And the times that stocks look cheap are when bad things are happening with that company or in that particular industry. To be a dividend growth stock investor looking for value, you've got to hold your nose and just understand that, when you're buying the stuff that you're buying, it's not because there's a lot of positive headlines, because the companies that are getting all the positive headlines right now are the ones that are overvalued or trading way over what fair price would be. Be greedy when others are fearful, as the Oracle once said. That's how I look at it anyway. Let me know what you all think. Congratulations if you're a Hormel shareholder on the dividend increase. I know it wasn't super exciting this year, but an increase is much better than nothing and even better than a cut. So I'll take that 3 cents per share of forward annual dividend income and wait for the recovery story and be encouraged that Hormel, despite a bad year and a half, hasn't broken that long-standing, very impressive Dividend King dividend streak. My name is Colby, the DGI Crab. Email me your questions, dgicrab@yahoo.com, where I will always respond to your email with an email, and I may even do a video response with your permission so we can all become better dividend growth stock investors together. Thank you so much for watching, and I'll see you on the next one. Keep investing.